We've taken in trillions of dollars. And by the way, all these countries signed agreements, as an example. They're all happy. Everybody's happy.
It's not a win for anybody. It's a miserable deal.
Time has already delivered its verdict. The tariffs launched by President Trump were supposed to revive American industry and bring in waves of foreign investment. Instead, even though a few trade deals have been signed, the evidence already shows the opposite.
Well, back in July, Seoul and Washington shook hands on a framework deal. South Korea would channel $350 billion in investment into the U.S., and in return, the U.S. would roll back some of its tariffs on Korean goods. But the deal isn't signed. Why?
And I think more generally, the commitment on the EU side to invest in the U.S. Manufacturing economy, very hard to see how that can happen.
The U.S. economy has not gained strength from these measures, and the promise of massive new capital has not materialized. From South Korea to Europe, announcements of hundreds of billions of dollars in investment remain stuck on paper. And most recently, a raid in Georgia has cast an even darker shadow over America's reputation as a safe place to invest. If allies and partners hesitate, if they question whether their workers will be welcomed or handcuffed, who will still risk putting money into the United States?
Add to this the recent storm, the Georgia raid. Over 300 South Korean workers were detained on immigration grounds. That has added fear among Korean companies.
The shock in South Korea is still fresh. In early September, more than 300 engineers and technicians from Hyundai and LG were detained in an immigration raid at a plant under construction in Georgia. They were flown back home on a special charter flight, and not a single one was charged with a crime. For families in Seoul, it was a humiliating moment. For executives in both companies, it was a warning that the U.S. may not be a reliable partner for large-scale projects. This came at the worst possible time. Just weeks earlier, Washington and Seoul had announced a framework where tariffs on Korean exports could be capped at 15% if South Korea delivered a $350 billion investment package. But the deal has stalled. The Korean president publicly warned that without a currency swap, such a transfer could destabilize his entire economy, even triggering a crisis like the one in 1997. The message is clear. Unless the U.S. provides financial guarantees and restores trust, that money will not flow. Instead of opening the door to investment, tariffs and raids have created hesitation. Europe offers another case where the promise has not matched reality. In September, Washington and Brussels celebrated a deal that capped tariffs at 15% and included an announcement of $600 billion in European investment by 2029. But the number is aspirational.
Not clear at all how the EU will be able to buy more energy from the USA, whether and how it will invest more in US manufacturing.
The European Union can sign agreements, yet the actual capital must come from individual governments and companies. No one has explained who will contribute, when funds will be released, or how they will be distributed. Public opinion polls across the continent show strong skepticism. Many Europeans question why they should send capital abroad when their own economies are struggling. What looks like a triumph on paper remains uncertain in practice. Canada, by contrast, has chosen a different path. Ottawa has not rushed to sign a deal with Washington. Instead, it is concentrated on nation-building projects. From critical minerals and energy infrastructure to port expansions and housing programs, the Canadian government is presenting itself as a stable destination for long-term capital. At a time when U.S. policies generate uncertainty, Canada is positioning itself to become a safer place for investors in North America. The contrast is striking. While Europe and South Korea hesitate, Canada is showing that caution and domestic focus can be more attractive than flashy but risky promises. Taken together, these examples lead to one conclusion: Trump's tariff policy has backfired. The numbers look impressive when announced, but they do not translate into real dollars on American soil. Instead of strengthening U.S. industry, the approach has fueled anxiety among partners and slowed the flow of foreign direct investment. Independent economic research published in mid-2025 confirmed that reciprocal tariffs reduce U.S. growth, increase inflation, and push capital away from the country. When that is combined with immigration raids on allied workers and financial demands that partners see as destabilizing, the result is predictable. The lesson is that tariffs can create headlines, but they cannot create trust. Without trust, the hundreds of billions in promised investment will not arrive. And without that capital, America risks falling behind, even as its closest neighbors prepare to take the lead.
71% of Canadian consumers say they intend to buy fewer American products this year.
Canada is a very tough country to deal with.
It's got some staying power. When Trump calls us the 51st state as a deliberate insult, it is amplified on social media. And so he's actually keeping it top of mind. He's keeping the boycott going.
It began with a remark that shook Canadians. In February, President Trump triggered a trade war and suggested Canada might be America's 51st state. What could have been dismissed as political theater struck a nerve. By spring, surveys showed 71% of Canadians plan to reduce purchases of American goods in 2025. Economists cited by CNBC warned the boycott could slice 0.3% from U.S. GDP this year, about $90 billion in lost output. Walking into grocery stores in Ontario or Quebec, the shift is plain to see. Where displays once overflowed with U.S. corn and berries, shelves now carry Canadian flags and Made in Canada labels. What began as consumer frustration has turned into a movement of economic nationalism. The message is simple. If there is a Canadian choice, that is the choice people will make.
The pressure is most obvious in food and drink. At Vince's Market, a Toronto-based chain serving 30,000 weekly customers, managers said that during Canada's off-season, they once relied on American produce for up to 70% of their stock. Today, that share has dropped to about 30%. Apps like MapleScan help shoppers verify origin and encourage them to favor local substitutes. Losses are clear in agriculture and beverages. Canada was the United States' second-largest food export market in 2024, worth $28.4 billion. California wines once filled 30 to 40% of red wine sales in Canadian shops. That revenue, about $60,000 a week for some stores, has evaporated. Provinces imposed a 25% tariff on U.S. alcohol this March, and bottles vanished from shelves. Imports of distilled spirits from the U.S., valued at $221 million in 2024, are being replaced by supplies from France, South Africa, Australia, and New Zealand. American farmers and vintners who depended on cross-border sales are watching demand collapse.
The boycott is not confined to products. Travel has become another front. In 2024, 20 million Canadians visited the United States and spent $20.5 billion. This year, the flow is shrinking rapidly. Online searches for U.S. trips from Canada dropped 50% in the spring. Land crossings in March were down almost 30% year-over-year, while air travel fell 22% in June, according to CBC. For border economies, this is a crisis. Restaurants, retail outlets, and hotels in Windsor and Detroit, or Buffalo and New York State, report vanishing traffic. The U.S. Travel Association estimated America is on track to lose $12.5 billion in international visitor spending in 2025 compared with last year. Local businesses describe empty parking lots and declining revenues with no clear path to recovery.
The White House insists tariffs are making America stronger, yet for U.S. companies watching their Canadian sales disappear, the picture looks very different. While Japan and the European Union have signed new tariff frameworks and South Korea remains in talks, Canada is drifting further away. Instead of cooling tensions, Trump's rhetoric often reignites them. By repeating provocative statements and doubling down on trade barriers, he has helped keep the boycott alive. The result is a cycle of loss. American producers are squeezed, border towns are weakened, and international travelers are looking elsewhere. Even in Europe, early signs show consumers turning away from U.S. brands, suggesting the damage is not limited to North America. For Canadians, the Buy Canadian movement has become a unifying act of resistance. For Americans, it is a warning that tariffs and insults can cost dearly in jobs, sales, and reputation. Trump promised to put America first. The irony is that his approach has left America losing ground in its closest and most reliable market. The boycott that started in Canada is proving durable, and the costs are mounting day by day.
Headlines concerning ag-related bankruptcies are on the rise.
Farmland here in the Midwest is abundant, with farmers growing corn, soybeans, alfalfa, dairy, and beef. But recently, in the first quarter of this year, many farmers couldn't repay their debts.
Farmers are under a tremendous amount of economic stress.
Across America's farmland, daily life is filled with challenges. Weather, debt, and volatile prices already weigh on farmers. In 2025, tariffs have made the burden heavier. President Trump's trade war is not an abstract debate in Washington. It is a reality shaping whether family farms can survive another season.
We worry about drought, we worry about pricing, we worry about equipment, we worry about financing. This tariff is just another thing that we have to worry about.
Soybean farmers in Iowa, who depend heavily on exports, are facing deep uncertainty. China, the largest buyer of soybeans worldwide, has not pre-purchased shipments for this year's harvest. Normally, China takes more than 1/5 of U.S. exports. Without that market, bins of soybeans may sit unsold, while bills for fertilizer and equipment keep climbing. John Deere has warned that tariffs on steel and aluminum will add $600 million to its costs in 2025. Those increases trickle down to every farmer who needs a tractor or a part repaired.
The story of soybeans captures the larger picture. American agriculture produces far more than the nation consumes, which means exports are essential. When tariffs close doors abroad, farmers cannot simply sell everything at home. Prices drop and revenue shrinks. This is not a new problem. In the 2018 trade dispute, retaliatory tariffs from China cost U.S. agriculture $27 billion, with soybeans alone making up 71% of the losses. Now history is repeating. Brazil has taken advantage of the opening, surpassing the United States as the world's leading soybean exporter. Farmers in the Midwest watch as markets they spent decades building slip away. Meanwhile, the costs of production continue to climb. Fertilizer, farm machinery, and fuel all carry higher prices because of tariffs on metals and other inputs. What was once a narrow profit margin has been squeezed to the breaking point. The financial stress is showing up in bankruptcy courts. In the first quarter of 2025, farm bankruptcies under Chapter 12 rose 95% compared to a year earlier, according to federal filings. Chapter 12 is a special part of U.S. bankruptcy law created for farmers and fishermen. It allows them to reorganize debts and keep their farms running while they work out a payment plan, rather than being forced to sell everything at once. In 2024, farmers in the Midwest filed 71 of these cases, a 69% increase from 2023. Behind every statistic is a family under pressure, often losing land and machinery after generations of work. When small and medium-sized farms collapse, their assets are usually purchased by large agribusiness operations. The trend toward consolidation accelerates, leaving even less space for family farms that still make up 95% of America's agricultural backbone. For many, the promise that tariffs would shield rural America rings hollow. Instead, they feel exposed to forces beyond their control, with little protection as prices drop and debts mount. Farming is more than business. It is legacy, culture, and identity. Yet that legacy is now at risk. Exports are falling, bankruptcies are rising, and uncertainty is spreading across the countryside. Even with new federal commitments, such as the $65 billion in agricultural spending signed into law in July, most of the money is directed toward crop insurance and disaster assistance. Those programs may soften the impact of bad weather, but they cannot restore lost markets or stabilize prices.
American farmers know the stakes. Without reliable trade partners and consistent policy, no amount of short-term aid will be enough. What they need is clarity, not chaos. They need stability, not shifting tariffs. Until that arrives, the reality remains the same. Trump's tariffs are leaving America's farmers squeezed between falling crop prices and rising costs, struggling to hold on to their land and wondering if the family farm can survive another year.